Retailers kicked off Black Friday well before dawn, in fact, before midnight in some cases, hoping for a big holiday shopping boost. David Rosenberg is the chief economist at Gluskin Sheff in Toronto. With consumers still a little skittish, he says they'll be saving more and spending less. He joins me now from Toronto, and I am here with Sarah Eisen to talk as well with David. David, now you see Sarah on screen, just so that we can make sure everybody knows what Sarah looks like again. You've been watching her all morning long talk about currencies. But, David, we need to talk a bit about holiday shopping. People accuse you, you've heard this so many times, David, people accuse you of being a perma-bear. But your concerns about consumer spending may be very on target right now. We are in what your friend, I'm sure, Gary Shilling likes to call the age of deleveraging. And people are holding onto their wallets and are a little bit concerned about how much money they can afford to spend with consumer credit tight. Tell us what you think is going to happen.
Well, firstly, anybody who's followed my career over almost 3 decades knows that I'm not a perma-bear, but have I been bearish for the better part of the past 10 years on the equity market? And the answer is yes, and probably not a bad thing when you consider what the equity market has done over that time period. But as it pertains to the U.S. consumer, I think that everybody's going to be focusing on the year-over-year numbers, and the year-over-year numbers are going to be distorted because stores are being more promotional, more discount-oriented, more online discount skewed. And so what's happening is that a lot of the Thanksgiving sales, I mean, yesterday online sales were up 10% year over year because there just wasn't that much of it by Thanksgiving Day 12 months ago. So the year-over-year numbers are getting skewed right now. I think what's going to be more important is not Black Friday, but it's going to be everything that happens between, say, the coming weekend and Christmas time. And my sense is that the numbers are going to be disappointing.
David, initial jobless claims moving in the right direction. GDP looks better. Consumer spending is up. What happened to your double-dip recession?
Well, it's been delayed but not derailed. I thought that by now the economy would actually be quite a bit weaker than it is. There's no question about that. But look, the Fed, if you take a look at the FOMC minutes that came out the other day, yet again just cut its forecast on the economic outlook. So I think we've got an economy right now that's running somewhere close to 2% growth. It's clearly not contracting. But normally at this stage of the cycle, going into the second year of expansion, the economy is normally accelerating at over a 5% annual rate. And here we are trudging in closer to 2%. So I've been probably excessively bearish near term on the economy, but it's still, for this stage of the cycle, we should be actually booming right now, and we're just meandering close to 2% growth. No question the claims moving in the right direction, but remember, jobless claims only give you half the story. They're telling you how many pink slips companies are handing out, what's happening in terms of firings, and firings are going down. But the problem is that nobody's hiring either. So this is consistent, I would say, with still a fairly stagnant, maybe moderately positive job market, but not anything that's going to cause the unemployment rate to come down anytime soon and trigger off a sustained increase in organic wage growth, which is what we really need to sustain the expansion.
David, let's talk about that, though, wage growth and QE2. Let's say QE2 actually works, and there are so many skeptics about that, but let's say it ends up resulting in some job growth, and let's say that companies start to borrow more money and consumers start to spend a little more money themselves. What is going to drive that wage growth long term? How do you translate QE into long-term economic health?
Well, I think that's a very circuitous route to talk about QE and then link it to wage growth. I think perhaps maybe you want to look at fiscal policy and its importance in its impact on the labor market. I mean, when the Fed came in with QE1, hey, QE1 was triple the size of QE2, and QE1 may have been successful in driving down credit spreads and mortgage spreads and maybe putting a floor under the housing market, although we know that housing is still doing very poorly. But when the Fed first embarked on QE1 back in March of 2009, their forecast for the unemployment rate today was that it would be 8%. And instead it's closer to 10%. So how is QE2 going to do any better than QE1 when it's a third of the size and the unemployment rate is still 2 percentage points higher today than it was when the Fed unleashed QE1 back in early 09. It makes no sense. I think that what people have to focus on in 2011 is that there is a major political shift happening in the United States, a major backlash against fiscal stimulus. It just so happens that fiscal stimulus, if you're watching GDP or you're watching employment or you're watching retail sales, that fiscal stimulus that now everybody doesn't want was a major source of support for the economy that falls by the wayside next year. Even if you get the Bush tax cuts extended in the next year, you're still going to have at least 2 percentage points of fiscal drag out of the government sector in 2011.
David, lots of doom and gloom on the U.S. Can Americans at least be thankful that we're not in Europe's situation right now?
Well, I would say that, are we or aren't we, Sarah? Well, I'm just saying, like, when you take a look at the state, what's happening at the state and local government level, like, look, the U.S. government can fund itself. We have control over our currency. We have control over monetary policy. Unfortunately, Ireland, Spain, Greece, Portugal, they don't have control over their monetary policy. They're like on a de facto gold standard right now. But in terms of America, there's more flexibility here. At the same time, look what's happening at the state and local government level. State and local government is almost 13% of GDP. Outside of the consumer, I know that today we're here talking about Black Friday and the consumer. After the consumer, the next biggest contributor to the economy in America, state and local government. And they're cutting back dramatically. I mean, you've got these gaping fiscal holes in most of the states and the municipalities in the United States. And what are they doing? They're either being forced to raise taxes or they're being forced to dramatically cut spending.
David.
And that's going to act as a huge tourniquet on the economy over the course of the next 12 months, too.
David, I'm afraid we have to end it there, but we're glad that you could join us here this morning. David Rosenberg, the chief economist at Gluskin Sheff in Toronto, talking to us about the outlook for the economy. More than just Black Friday, David rejects the title of a perma-bear, but he has some serious concerns about the future.